For many of our clients operating across the EU, they're the ones responsible for charging VAT. However, there are certain circumstances whereby a customer will account for VAT. In certain member states, where a non-established supplier is supplying goods, it is the customer's responsibility to account and report the VAT. This is what we would commonly refer to as domestic reverse charge mechanism. My name is Michelle Lang, and today I'm joined by my colleague Ryan Devaney, a senior manager in the consulting team, and Owen Rogers, a director in our tax technology team, who've been working with clients for a number of years in supporting them understanding the VAT rules and managing these issues through the Meridian solution. Ryan, firstly, if we can come to you, maybe you can talk us through the VAT aspects of the domestic reverse charge mechanism.
Absolutely, thanks, Michelle. Yeah, so as you said, Michelle, the domestic reverse charge is a VAT collection mechanism within the EU that holds the customer as liable for the collection and payment of VAT on certain domestic supplies of goods and services. And the one that we're going to look at today is the domestic reverse charge that's applicable to domestic suppliers of goods and services made by a non-established supplier. So if we take a look at this example, we have a German established business selling from a Belgian plant domestically in Belgium to their Belgian customer. And in this case, the domestic reverse charge applies, which means that the supplier won't charge any VAT on their invoice. Instead, it's the customer who will self-account for the VAT via the reverse charge mechanism, recovering the same as input VAT subject to normal recoverability rules. So that, in a nutshell, is the domestic reverse charge. It was primarily introduced as an anti-fraud measure to stop non-established businesses being responsible for the collection and payment of VAT, but it also serves as a simplification because that German established supplier, having no other taxable activity in Belgium, can avoid a Belgian VAT registration. If we look at some complexities and challenges that businesses face within this area, well, first and foremost, the domestic reverse charge is an optional mechanism. And that means that not all member states actually apply it. So some will still have the non-established business charging VAT on domestic supplies. And moreover, the conditions for its application for the reverse charge to apply are left for the member states to decide. And so you will have different conditions applying in different EU member states, usually based on the status of the supplier. So whether or not them having a VAT registration means that it will be disapplied, and looking at the status of the customer. So whether the customer must merely be VAT registered or whether that customer must also be established within the particular member state. And practically, we would see challenges for businesses, particularly operating in multiple EU member states. They need to be aware of the specific rules in that member state, and they need to be aware of the status of their customer and or supplier, depending if they're selling or purchasing. And I think that challenge, as we'll see, is certainly reflected then in some of the systems considerations. As we know, ERP systems as standard not usually equipped to deal with more complex situations within VAT.
Okay, thanks, Ryan. Owen, as Ryan mentioned, there's a lot of differences in the member states in terms of the particular conditions to apply for domestic reverse charge. So maybe you can talk us through how the Meridian solution managed this for clients.
Sure, absolutely. And as you said, Ryan, SAP is difficult to fully automate. It's quite rigid in the way it's set up, and the flexibility is not there to make different determinations for different types of flows. So I'll try and illustrate that here. And what we're seeing is I'm going to create an example like the one you mentioned, where we've got a German established selling organization using a Belgian plant that belongs to them. So using their Belgian VAT registration in order to make a local sale in Belgium. And because of the fact that they are only locally registered in Belgium, selling to a fully established customer in Belgium, that domestic reverse charge rule should apply. But as you see here, when I'm selecting the plant, the difficulty with SAP is that because this is a Belgian plant, SAP will automatically understand this is a domestic transaction, which is correct. It's Belgium to Belgium, but will only ever be able to either charge VAT or not. So that flexibility to make decisions based on the underlying data about your customer and seller is not there. So with our solution, we have a number of checks that we do. And then using specific table entries, we're able to update the customer tax classification just for this transaction dynamically when all of those conditions have been met. So in this case, we know, judging by our system, that this is a German established company. Because we're using a Belgian plant that does belong to them, so it is a plant owned by the selling organization, therefore they should use their local Belgian VIDA ID. But because our customer is established in Belgium and we are not, the local domestic reverse charge rule should apply. So as you see here in the condition record, we've changed the customer tax classification for an E to identify a difference in this transaction from a standard domestic transaction. And that allows us to point to a tax code that reflects the domestic reverse charge. And that's dynamic for this transaction, not hard-coded in the system, because if we start to change the parameters of this transaction, like a different selling organization or from a different plant or to a different customer even, or maybe even the Incoterms can have an effect, we have to be flexible enough to decide on the tax treatment at the time the invoice is created, rather than setting hard and fast rules that are not flexible in the system.
Okay, thanks, Owen. And Ryan, back to you, just in terms of VIDA, in principle now the rules around the domestic reverse charge should be harmonised across the EU, making it easier, at least giving more certainty to businesses.
That's absolutely right, Michelle. So there will be the harmonisation and a mandatory domestic reverse charge in a specific scenario whereby the non-established supplier is not VAT registered, selling domestically to a VAT registered customer. You're going to have an EU-wide mandatory reverse charge. So we certainly expect that there'll be some harmonisation, simplification of the existing optional reverse charge after VIDA. However, outside of that specific scenario, so let's say that the non-established business has a VAT registration number in the particular member state, or indeed if there's a domestic supply chain involving two non-established businesses, we know that one of them will need to be registered, either to self-account under the reverse charge or indeed to charge VAT. And so we still expect there to be complexity even after 2028 when VIDA is implemented. There's still going to be that need for businesses to understand the rules per each member state, because those scenarios, as I say, it's the member states that will again be given freedom to choose the specific conditions. So definitely expecting some complexity in this area to remain. And again, going back to the systems, requiring, let's say, some form of customization or some solution in order to maintain those rules, and indeed as a VIDA to actually change the rules, because we'll expect some rule changes in different member states.
It's just interesting that you say that, because with our solution, we do have that flexibility built in already. So as you can see on the screen here, for our table that will determine domestic or extended reverse charge, as we call it, we do have a number of options that are flexible per country and sales organization, where we have to determine basically on the customer status in that jurisdiction, does the customer need to be established, or is it okay if they're not established? If the customer is not established in the selling country, do they have to have a fiscal representative? We have code that will allow us to check the customer master data to see if a fiscal rep has been applied to that customer. And then also, are we going to allow the extended reverse charge rule even if the seller is not locally established or registered? So all of those decisions can be made on a country-to-country basis, even for specific sales organizations if necessary. And once those rules are met, this is where you'll see the customer tax classification information is, that we can update the transaction just to point to that tax code for that one transaction. So that flexibility that VIDA will need is already within our system.
Thanks, Owen, and thanks, Ryan. That's been very useful. I think while the domestic reverse charge mechanism can be beneficial for businesses in potentially removing registrations or alleviating cash flow with charging and recovering VAT, it is quite complex, and it is important that it's applied correctly, as it can result in underpaid VAT together with interest and penalties. It's also important for businesses to have a robust and flexible solution that's automated and not reliant on manual processes and users being VAT experts. That's it for today. If you'd like more information on the Meridian solution, please contact us at meridianglobalservices.com.